Kristina, let me start with you, because we've just talked about what we think is going on with the Fed, what's going on with the economy. How do you put together a portfolio? How do you allocate your assets in this world?
Well, first, David, I have to answer the question I keep getting asked, which is the 60-40 portfolio still alive? And I think to a certain extent, it very much is. The concept of diversification is so important, and I think we will see the benefits of it this year. And actually, not just equities and fixed income, but some alts in there as well to provide lower correlating assets. My view is, as with JoAnne, I believe we're going to see a significant amount of volatility, especially in the first half of this year. There's just an awful lot of uncertainty. So we're going to want to have exposure to fixed income and some dividend-paying stocks. We need that income to stabilize as we move up and down. I also believe that as we move further into the year, we're likely to see markets start to discount an economic recovery. And so that would be a time to start to perhaps increase equity allocations, especially among the more cyclical parts of the stock market. But fixed income looks attractive, especially investment grade. Munis, those are very attractive yields right now. I like to think of this as almost a golden age of fixed income. So that's an important component of portfolios right now.
JoAnne, what do you think? I mean, it sounds like a fairly diversified approach, but with an emphasis on getting some cash, whether from dividends or otherwise.
Yeah, we offer a range of opportunities. It really depends on the client, on the investor, and what their time horizon is. You know, at this point, there are certainly some opportunities in the market that if you're a long-term investor, you can be all in on equities. But, you know, a lot of our clients are also looking for that cash flow. And so, you know, we like to offer them choices, a mixture of stocks that will appreciate versus stocks that will deliver that yield alongside of fixed income. And let the client really decide, you know, how much they want to put into equities at this point based on their time horizon and their risk. But yeah, I mean, I agree, given the volatility that we've just talked about, this is an awfully good time for a balanced strategy to protect the principal in the portfolio. And hopefully, if you can get enough of yield on the dividend side and also on the fixed income side, you can eat your cash flow to pay your expenses if you're in retirement. And that will save you from having to sell stocks when the market does go down, which inevitably it's likely to do along this very bumpy road to get beyond this inflation period.
JoAnne, do you take a look at what got beaten up the worst last year? And last year was a tough year for both stocks and bonds, right? But do you look at things like tech, for example, which really took it on the chin in part because of the discount rate, right? Because they were raising rates, and say, you know what? I think they've taken their hits. They might come back this year.
Yeah, when you look at the tech space, two things happen, right? Certainly what you said, David, you know, the interest rates went up and they started going up in November of 21 and tech stocks started coming down. But the second thing that happened, you know, in retrospect, we can see this, is there were some folks astute enough to recognize that growth of these big tech companies was going to be slower, at least for a short period of time. And if you have enough short-term investors, the hedge funds and whatnot, they're going to get out during this period. And that's what we saw. We do think that was a big headwind for a lot of these stocks. This year, you have far fewer rate increases coming than we saw last year, less of a headwind for those tech stocks. And we believe that towards the second half of the year, and investors are going to start looking now, as we believe they did in January, we should see those growth numbers start to turn around again, and then particularly more so in 2024. So we do think it's a good opportunity to pick and choose among the tech stocks, find the good valuations relative to their growth opportunity. And if you're a long-term investor, this is a good time to put some of that in your portfolio.
Kristina, what about you? As JoAnne just said, it can't be the case we're going to have as many rate hikes this year as we did last year, I don't think at least. So what does that mean? Certainly it says something about bonds, but beyond that, what does it tell you about, as an investor?
I do think that it gives certainly some space to technology, right? The tech sector is likely to start to see better performance, especially as rates come down. But I also believe that what it really does is clear the way for an economic recovery, right? That once we have a stabilization of rates, that is really when the economy can start to recover, accelerate, and I think stocks are going to anticipate that. So we're likely to see smaller caps perform well. I also think the dollar is going to be relatively weak this year. That's a trend that's going to continue. So emerging markets equities, especially Asia EM, we haven't even talked about the China reopening, but that is going to be really powerful for Asia EM.
Well, what about JoAnne, briefly here at the end? Strong bounce back, do you think, this year?
In the overall stock market,
yeah.
I think the jury is still out on that. You know, looks pretty good from the consumer side. fewer rate increases is a good thing. But ultimately, we do have a pretty substantial decline in certain sectors of this economy. We have to see if housing comes back. So I think it's an open question. That's why we are counseling to really diversify and be prepared for volatility.